Before we jump in, I want to share a brand spanking new review. I was so excited when I saw this just the other day. It says must listen for gym owners, and it's by Michael W. After years of chasing revenue goals, Billy helped me shift my focus to profitability. He guided me through a cadence of behaviors that has massively changed my business, reduced my financial stress, and given me the confidence to chase another level as a gym owner. I love it. That makes it all worth it. So thanks so much. If you haven't yet left a review, would love for you to do that. Today we're diving into something that it's hard to make exciting. This is not something that you're generally excited about. It's not something that you got into business for, but we're talking about a little something called taxes. And I want to encourage you to don't log off, don't X out or stop it and go to one of the other podcasts out there that talks about getting more leads and getting more clients, because this is going to help you way more in the long run. I promise you, you have to get a handle on this if you ever want to find financial success. I'm going to make it really simple. We're going to focus high level to make sure that we're not getting too caught up in the weeds. Going back, when was this? This was 2011-ish. 2011. Somewhere around there, 2010. I was at Panera Bread. I was sitting there with my buddies. We had just finished training jiu-jitsu and going there for some post-workout nutrition. Remember the half and half deal was like half salad and half a sandwich. I think I got like two of those. So it was like a lot of food sitting there, and I get a phone call. And it's a guy named Paul. Paul was my CPA at the time. And when I started with Paul, I was brand new in the business. Paul was so kind. He decided that he would do my taxes. And he was like a super high level accountant. He was partner of a big Long Island CPA firm. He had some really big wig clients. I was definitely on the lower end as I was starting my personal training business, but at this point, things had moved along. I was starting to make some money. And Paul, at that point, he wasn't charging me. He was doing my tax returns for free. I got this text, and I step aside from the table and walk over to the window of Panera Bread and I say, "Hey, Paul, what's up?" He says, "Billy, I have good news and bad news. The good news is you're finally starting to make some real money. But the bad news is you owe $6,000 in taxes. And it's due by the end of the week." "Paul, today's Thursday." "I know, but if you don't do something, there's going to be penalties and other fees associated with it." That was a huge shift for me, needless to say. I got my stuff together and I became really good at taxes, and it's made all the difference. I ended up shifting gears and going with a different CPA that I actually paid, and I got really on top of it. I became the guy that was really interested. I learned a lot. I was I was like the best client. My tax return would get done first because I was all paid up. It was just a matter of signing, and the stress that has reduced over the years has been dramatic. Full disclosure, I will say this year is a little tricky. Last year, I sold my gym in New York. I moved a couple of years ago to a totally different state, all different tax laws. I have capital gains taxes on the business that I sold in New York, and then I have this other business here, and so it's a little bit tricky here. And I would say I'm way better off than I was at Panera Bread that day, but I would say I'm the least prepared than I've been in a long time with taxes. But the difference is now I'm taking action. I'm getting on top of it. Have a new CPA here, getting systems in place, getting dialed in because I know the importance of this. I want to share that partly so you know that you're not alone. I have this podcast now for 5 years. the Your Fitness Money Coach podcast, I do solo episodes and I do guest episodes. For those of you that listen, you know that. And one of the questions I ask is, what's the biggest mistake you've made? And this issue of taxes, it comes up more often than not. It's the most common answer. So we need to take the clues there. So you're not alone. It's super common. It's one of the most common issues. Let's talk about why that is. Why do people fall behind on their taxes? The first, and I'm going to be a coach here and tell you like it is that there's a lack of understanding of profit and what profit is for and what the purpose is. We know profit, yes, it's income minus expenses, and that's my profit, but we get confused about what that's actually for. You see, most business owners, they have revenue come in, they have expenses go out, and whatever's left they think is theirs, and they generally take it. And that's only one of the things that the purpose is for. There's several other things, other jobs that profit has, and I'm not going to get too far into the weeds and all those different purposes, but one of them, and this is the one that arguably, I mean, there are some competing purposes, so it's hard to say. I love the idea of like, this is number one, this is number two, this is number three. It's hard because there are three that jump out to me. I mean, there's other ones too, but taxes, it's got to be number one, because for every dollar that you make in profit, that dollar's not yours. A certain percentage of that has to go to the government. The government is going to get their money. You don't want to mess with that. If you want to have clarity, if you want to build wealth over time, you have to get your tax system in order. The other two that I was thinking about was, yes, depending on how you look at it, so profit, it doesn't get defined different ways, but depending on the structure of the business, it can be looked at different ways. Some people think of profit as above and beyond what the owner is making. So the owner makes a reasonable wage, and then everything above that is profit. But for tax purposes, you're making you have to make tax payments on all of the profit, whether that's coming in the form of a W-2 salary, or it's coming in the form of an owner distribution, or if you file taxes as a Schedule C, it's coming in the form of an owner's draw. It doesn't matter. You don't get taxed on the type of transfer. That's a big misconception, just to kind of stick with this point. Actually, that's my second one here on why people fall behind, is because it's confusing. And people are very confused. They think they pay taxes. I've had people tell me, and by the way, full disclosure, I'm not a CPA. Talk to your CPA. Don't take any of this as accounting or legal advice. Just sharing my perspective. But a lot of people have told me like, oh yeah, I can't transfer that money to my personal account because I'll get charged taxes for it. And while there may be some odd scenarios where that's the case, for 99% of the people that I've dealt with, that's not the case. They are getting taxed on the profit of the business. It has no bearing where that money is. The money could be spent on a steak dinner for you and your family. It could be left in the bank. It could be invested in a Roth IRA. It doesn't matter what's done with the money. It's taxed because it was profit. So that's an important distinction. But anyway, there's a lot of confusion. Depending on how the business is structured, there might be payroll taxes that we have to think about. There's self-employment taxes. There are federal taxes, and that's going to depend on your rate. That might depend on the income level that you have. You may be filing singly. You might be filing jointly. Then there's, of course, the state tax ramifications, depending on what state you're in. I'm in the state of Tennessee, where there are no state income taxes. But there's other factors. Here they have excise taxes, which are another factor. So it's going to be very dependent on your situation. So it's so confusing. What happens when people get confused is they definitely don't become big action takers when they get confused. That's one of the other things. And to add to it, it's always changing. Just as of right now, I think it was was it July 3rd or July 4th? There's this big tax bill, and that's changing things. It's changing what is a credit, or the amount of credits, and what's deductible, and how much is deductible, and who qualifies. All these things are changing, and they change as the political climate changes, and it's hard to keep on top of because you're busy working your business and training people. So you need people like me, hopefully sharing some content with you that's going to keep you focused, and that's why we're here. So thanks for doing that. The next reason why they fall behind is because there is no system. We're going to talk about that today, but you don't rise to the level of your goals, you fall to the level of your system. That's what James Clear says, the author of Atomic Habits, and it's a brilliant quote, and it's very true. We don't have a system for being prepared for taxes, and there might be a lot of pieces of that system, but we're going to break it down really simply today. You're in good hands. Your life is going to change. The last reason why people fall behind is that it's an emotionally heavy area, depending on your relationship with money. Maybe there's some real tough times like I had with a car repossession. It's so easy to ignore because it's just feels so overwhelming, so scary, so confusing. It touches so many different areas. We get so emotionally overwhelmed that we just sweep the dirt under the rug and we end up with a big pile of dirt. Here's maybe a different take than what you've heard, but taxes are like, is it a double-edged sword? Is that the right phrase? If you're not making profit, I'm not saying this, but one could argue that it's good because you don't have to worry about taxes. But the downside is you're not making any money, right? So it's not good. If you're making money, aka profit, you are paying taxes. So the sign of your success is the amount of taxes you have to pay. And that doesn't sound fun, and it's not. And people will tell you all types of things, and there may be some things you can do to help the scenario, but most of it is BS. Most of it is either unethical or just untrue. You can only lower your taxes so much. You have to pay taxes on your profit. So if your taxes are getting lowered, generally speaking, that's because you have more deductions. Your expenses are going up, and by the expenses going up, you have less money. And if you want to build financial wealth or financial freedom, you need money. So you can try all the tricks in the book by buying this and buying that so you don't have to pay as many taxes. But at the end of the day, it's going to reduce the amount of money you have. For example, if you save 30% on the dollar for an additional tax deduction, you spent $100, yeah, you get a $30 savings in terms of that deduction, but you also lost the other 70, right? So you gave up $30 and you lost 70, right? So that's not a good trade-off. Yeah, if it's a legitimate thing and you really need it, it's really helping, yes, but at the end of the day, you have to accumulate money to have money, right? That's kind of common sense, but we often lose sight of that. So just a reminder, if you're paying taxes, that means you made money. You just have to learn how to manage it and create a system. And that's what we're going to talk about now. So what do you do if you don't have a system and you want to get on top? But this is way too much to cover in just a short bite-sized episode. So I want to encourage you, if you are ready to start taking positive steps to get your financial house in order, reach out to me. Schedule a call with the link in the show notes, and we'll just talk through it. I'll help you apply specifically to your unique scenario. There's lots of factors. I can't go through everything, but I'm just going to share an overview. Number one, this is probably good for anybody. Figure out where you are. As of this recording, we're in, based on the calendar year, we're going into month 7 or 8. Yeah, month 8. And a lot of the year is behind us. There's a decent amount in front of us. It's not too late. So figure out where you are. And what I mean by that is determine what your year to date, that's from January 1 until now, depending on when you're listening, what is your net profit? If you can't figure that out or find that information very quickly, that is a big red flag. As a CEO, as an owner of a business, you must be able to know how much money you're making. That's a separate issue. It's related, of course, but if that's hard for you, if you're not sure, you're like, I gotta check this spreadsheet. I don't know if it's accurate. I'm not sure what's what. I'm not sure how things are categorized. This is your reminder. Let's get it together. Treat your business like a business. You deserve it. You can do it. I'm here to help. I can help you on all of these things. I can help you with the bookkeeping. I can help you with the systems. So just reach out, because that's why I'm here. And from there, you're going to estimate how much you should have saved for taxes. Businesses are generally required to make quarterly estimated tax payments. If you haven't done that, that's another flag. And maybe there's a reason, maybe not, but you want to know that. The next one to think about would be September 15th, would be the Q3 quarterly estimate tax payment that you can make right through the IRS website. But compare where you are now. So, okay, this is my net income. Let's run some numbers here. Let's just say you have been making a net income of $5,000 per month, and we are 7 months in. It gets a little tricky when it's not consistent. So you have to figure that out for yourself. So that's $35,000 net income. Then, and I'm going to keep this really simple, but you're going to want to project like how much. Well, not project. You're going to want to figure out how much you owe based on your specific scenario. But I'll give you a simple ballpark that it's one of those things that people kind of argue over a little bit here, a little bit there, when nobody's actually doing it anyway. It's like the argument of investing. You know, people will go back and forth over, well, this will get a 0.5% more, and the truth is that's fine. But the bigger deal is not actually doing the thing. We talk about the workouts. This workout is better than that workout, or this nutrition plan is better than that one, and that may be true. But the issue for most people is not that they're not following the perfect plan, it's that they're not following any plans. It's very similar when it comes to your tax scenario. So I am going to not over talk this point. I'm just going to say, and I can explain why I'm saying this if you have further questions, but I just don't want to bore you to death, number one. Number two, I don't want to create the same problem where we're getting so in the weeds that you're not doing anything. But again, I mentioned earlier that there are the different factors. There's going to be the federal taxes that you're going to owe. There's going to be the self-employment taxes that you're going to owe. That is set up a little bit differently depending on how your business pays taxes. But if you would just, for now, and keep in mind, I get a little concerned. I'm gonna that you're gonna hear this wrong. I'm not saying this is like the perfect plan. I'm just saying for starters, if you have no other plan, because the idea is that we get taxed on our profit, and generally, most of the business owners that I've worked with, they spend their profit. So, for example, what I mean by this is, it's a rare scenario that somebody is making a boatload of money and keeping most of it in the bank. If that's your case, you probably have your taxes figured out if you're at the point where your business is that healthy. So this may not apply to you. But if that is your situation and you don't have your tax system figured out, then this specific idea won't work for you. Because, for the same reason that I keep saying, it's because you're taxed on your profit. You're not taxed on what you pull out. Most businesses, things are pretty tight. Money comes in and money goes out, and there's not necessarily a ton of surplus building. If there is, you're going to want to base this off of your net income, not how I'm going to say it. But a good system for someone, especially when you're starting out, is for every dollar that you pull out of that business, especially if you pay your taxes as a Schedule C, because you're taxed on all the profit of the business. So every dollar you pull out, you're going to save 25 cents into a tax bucket. So you're going to create a separate savings account where you save for your taxes. You pull out $100, $25 goes in the tax bucket. It's so much easier to do that than to figure it out after the year's over and figure out 25% of everything you took, when you could just do it little by little and you actually have what you need to pay your taxes. If I will say this, if you do pay taxes as an S corp, there's a few different ways to do all of these things, right? So I don't want to overcomplicate it, but keep saying that, and I probably am. But if you're paying taxes as an S corp, then, or filing as an S corp, then you have wages just like any other employee, and then there are potentially distributions, which would be actual profit on the P&L. They would be from the profit, I should say. You should, is a strong word, but have withholdings, which means that you're paying your taxes on your salary through your payroll, but then on the rest of it, you would want to do what I'm saying, if that's your scenario. Again, reach out to me if you have specific questions, because there are a lot of factors, and I hope I didn't lose you. If I did, I apologize. And the last piece is to start now. I always encourage people, if they're behind. I was behind. I told you I had that call from Paul, $6,000. I had to set up a payment plan with the IRS. Not fun. They're not the best creditors to have. But what I focused on was getting current, and then I made a plan to catch up. And that's what I encourage you to do. If you're behind, get current. Start doing what I just said with the 25%, and then make a plan to catch up on the rest. You might just budget it out for the rest of the year. If you're $5,000 behind, divide $5,000 by the amount of months that are left in the year and figure out how you can save that amount each month so you can catch up. But don't let that stop you from getting current. So get current first, and you will catch up. I never thought I would, and I did. And once you catch up, you got to keep your system going. Here's a little bonus for you. Here's what I want you to not do with this information. Number one, don't hear this and ignore it. This is a wake-up call. You're hearing this for a reason. Number two, don't panic. It's going to be okay. It's probably not as bad as you think. You can fix it. And then finally, the cash in your business is what is your lifeblood. So you got to make sure you protect your cash. Get caught up, but don't spend every dollar so that you drain your entire business and then you put yourself at a tremendous risk. We definitely want to prioritize this. With that said, we don't want to go out of business. So make sure that you're maintaining a certain level of reserves as you're catching up. So get aggressive, but not aggressive to a fault. I know this was a little bit different. I know it's not the most exciting topic for people, but if you're serious about getting on top of your finances and being successful financially, this is something that you will take heed on. So I'm here for you. Let me know if you have any questions. Reach out to me at on Instagram, Billy Hofacker, or on email, financialfreedompt@gmail.com. Thanks so much for tuning in for this super duper exciting special episode of the Your Fitness Money Coach podcast. Till next time, you're listening to the Your Fitness Money Coach podcast.